So I'm trying something new to try to demonstrate the value I provide to companies with this video. If you like my work or appreciate what I do and want to help me get to keep doing it, or if you think Contango potentially makes sense to you as an investment, please consider clicking the link you see below now or in the video description below and signing up for Contango's newsletter. I know it's an ask, and I generally try to rely on producing quality work for quality companies and just let that do the talking for me, so I appreciate it. Thank you. Okay, on for the first time, I have Rick Van Nieuwenhuizen. He's the CEO of Contango Ore, and they trade under the NYSE under the ticker CTGO. I've known Rick and I've known Contango for a little while at this point, and I've always thought that what they had was a pretty clever idea. They're not really, they don't fit the mold of a traditional explorer or producer. If I can be so bold, I think they've actually managed to sort of create their own sort of company model built around what I feel to be is a fairly simple and effective selection process. It's a direct ship ore model, DSO for short, and I won't get too much into that. I'll let Rick explain that one to start our conversation. Just to finish off some thoughts, though, they are an Alaskan-focused, one part explorer, one part royalty co, one part toll miner, and they are actually making money, right? That's a rarity in this game sometimes, actually making money, forecasting $56 million in their revenue from their JV with Kinross. Share count, as you can see here, I mean, this is one of the big parts for me. Fully diluted, just over 13.1 million, and that's actually less than a double in the 4 to 5 years since December of 21, which in this game is absolutely excellent dilution management. Lots of analyst coverage, as you can see on the screen here. Lots of formal industry recognition in terms of funds on the registry, participation in market sector ETFs, etc. Smart team. This is one that I like and one that I hope that I can continue to work with. And let's see if we can get the story told pretty decently here today. But yeah, Rick, I guess I'll pass it off from you there to you. Thanks for coming on, and good to talk to you. And I guess, yeah, maybe why don't you just lead us through DSO and what that means to you and what the relevance is to your company.
Sure thing, Matthew. Thanks for having me on. As you said, direct ship ore is the long form of the DSO model, and essentially we've arrived at this model. I've got a long history in exploration, of BP exploration for Placer Dome. Worked all over the world. But working in Alaska in particular, working in the United States, permitting is a real challenge. It's well known. It's being discussed. Hopefully, we get to permitting reform, but so far it's all talking and not a lot of actual action taking place. So, we found the Donlin. I started NovaGold 25 years ago or more, and we found the Donlin project in Alaska, 40 million ounce, 2.2 gram per ton. Beautiful, large, high-quality ore body in the middle of nowhere, and here we are 25 years later, and they're still permitting and litigating that project. So that history kind of got me rethinking about I'd like to actually build some mines and get some production and get some cash flow rather than trying to run a junior company with your hand out all the time. And so we went to this model of focusing on finding high-quality deposits, which generally translates to high grade. That's not the only criteria, but it is certainly probably the most important, because you can't do anything without grade. If you've got 1 gram, you're hoping you can get it to the edge of the pit, basically. So focusing on grade, focusing on the other characteristics that make things easier. And I'm talking about in the context of Alaska. So that, first up is infrastructure. So near a road, rail, near the water. And projects, if you're not, so the DSO model, you're mining, you're taking a run-of-mine material, you're putting it in a truck, and they're transporting it to an existing permitted mill facility that has capacity or can be financially induced to have capacity to process your ore. And typically, higher grades will displace lower grades. There's a business transaction to be made if you're bringing 8 grams per ton to a mill that's processing 0.6, which was the case with Fort Knox. So that was the sort of how this thing came together, and we had a long dialogue with Kinross and arrived at a 70-30 joint venture where we took advantage of their existing mill facility at Fort Knox. We batch processed the ore, basically running the ore once a month, or 4 a month, once a quarter. So 4 batches a year. So we ended up producing about 42,000 ounces of gold for our 30% share. And we demonstrated that the model works. It's not without challenges, but it works. Nothing in the mining business is easy. We got things permitted in a year. Or at least the federal permits was permitted within a year. And typically that's a wetlands permit in Alaska. When you trigger a federal action, you have to go through NEPA, National Environmental Policy Act, and you have to do a bunch of environmental studies and community outreach. But we got all that done in a year, and then the state permit, again, since we're just mining, we're not building a mill and a tailings facility, we don't need 20 megawatts of power and have to have an air quality permit and all those other things that you have to do if you're going to build a mill and a tailings facility, and that's what takes so long. So we, the benefits of a DSO model is it really shrinks your environmental footprint because it's basically where your mine's located. And if you go through and select projects that aren't in the bottom of a river valley and where everything's a wetlands, but something that's on top of a hill like Manh Choh, you can see where in the photo there, it's on top of the hill. It's a great place for a mine, and it's because you don't have a lot of wetlands to disturb. The road access down to the highways where the wetlands were was only 5.6 acres of wetlands disturbance. So we know the model works now, and so we've identified a couple of other projects and acquired those projects. Our Lucky Shot project in just north of Anchorage, and our more recently acquired Johnson Tract project. They fit all these same criteria. They have grade, they're close to infrastructure. In the case of Lucky Shot, it's close to the Parks Highway and close to the Alaska Railroad. In the case of Johnson Tract, we're 20 miles from the coast. So put this thing on a barge, and there's a lot of places you can go once you've got it on a barge. So that's we're going to execute the model, and we've got Manh Choh running. We were actually in the middle of our first batch of processing Manh Choh ore for 2025. Yeah, we're demonstrated the model works. We're generating cash flow. First order of business, and I'm sure we'll get into that, is paying off the bankers and delivering into the hedges, and we can certainly talk about all that.
Yeah, no, we'll get to it. Yeah, I think that what attracts me to DSO, and you'll excuse me if I kind of butcher an analogy here, but I think that sometimes you have conversations around Contango with current shareholders, and the people that disagree. I'm thinking even just back to Kinross and yourself is, you're giving up a piece too much of the pie, or you're giving up a piece of the pie that they feel it should be theirs. But for me, and this is where I think this is a great model. You actually get to eat the pie, right? And not a lot of exploration companies actually end up with pie on their plate. If I can, like I say, be a little pithy, but no, I think that that's actually it. I mean, you're 56 million revenue forecast for next year, right? Not a lot of like you say, in just a few years, you have a potential to be a very powerful company in terms of your cash flow. I guess maybe let's just flip that though, right? I mean, so for me, there are obvious benefits, and why I like DSO is that a lot of it is that same sort of checklist that I bring to bear when I look at companies too, right? So I like there's a degree of synergy to how Contango approaches projects and things that I look for as well, like you say, permitting and jurisdictional access or ease of permitting. Let's flip it though, right? I mean, for me, considering DSO, do you get? My question ultimately would be, what are the challenges or the risks? And I'll just start with my own interpretation of that, and you can tell me if you agree or disagree. But it's just execution is all the more important, right? I mean, it's not just one project; it's multiple. It's navigating, 2 or 3 projects to string together to create a typical 12 to 14 year life of mine life, right? So that execution always is critical in this industry, but maybe more so for this project, for this model of company. Is that maybe what you'd consider maybe the key risk or challenge to DSO, or what are your thoughts on that?
Yeah, I think I have a couple of things. I think what you're pointing out is right, and kind of along with the DSO model, I would say the other thing is looking at it as a hub and spoke. So if you have a mill facility, then huge advantage because you don't have to re-permit all those things. You just have to worry about the transportation effort to get it there. And there's certainly issues to deal with there, and we can talk about those if you'd like. But so the hub and spoke model is, I've got a nice mill now, but let's go focus on things that are in some sort of a bullseye target area that says, if I've got I look for things that are 2 grams out to this area, and if I'm out of here, I got to be 3 grams or 4 grams in that concentric circle sort of a pattern. Mm-hmm. So yes, that's very much how we're thinking about this, and especially going forward, Fort Knox is a great facility. It's a great piece of infrastructure, and certainly we've got a good working relationship with Kinross. So if we identify the things that could go to Fort Knox, we'd certainly have that conversation. Lucky Shot is certainly a possibility. We're very close to the rail. The rail goes to Fairbanks. So that's, it's something that we'll have a discussion on. But it isn't the only option. We could also buy a mill, or do a tolling arrangement somewhere else, and have a business relationship with someone else who, besides Kinross, who has a mill with potentially excess capacity. So, and again, excess capacity can be created by, bringing 12 grams to a mill that's running 5 grams, right? So that's how we're thinking about this, and we've got a lot of experience in Alaska, so we're looking at Alaska, but we're looking at other jurisdictions as well. We think this model applies elsewhere. It's actually a lot more, the model, if you will, the DSO model is a lot more in use in Australia. Probably because it's so easy to transport things in Australia. I would guess that's one of the reasons, and maybe it's just part of the mentality that you get a mill and you see suddenly things that are being transported 100, 300, 200, 300 kilometers to the mills. I think there's a lot of junior companies in the typical junior exploration story, and certainly we've done this before. Is, hey, I'm going to go find a 5 million ounce gold deposit, and we're going to do all the things, and hopefully somebody buys us, before we have to actually build and operate this thing, because that's a big deal. Building a mill and a tailings facility, and permitting all those things, it takes an inordinately long amount of time. It's not cheap. It's a boring part of the Lassonde curve. That's the life of permitting, and nothing ever goes as quickly as you'd like it to go.
Why don't we, again, I'm trying to, I was kind of warning Rick that I'm trying to at least have enough sort of basic information for people that are new to the story to kind of keep up with the conversation, but I also don't want it to just be sort of rote slide deck conversations. And so I kind of warned him, hoping for brief overviews before I can kind of dig into details here and there. But why don't we just do, again, I'm trying to structure this, introductory, at least to some degree. Let's run through. You've got 3 projects as they stand right now, 3 core projects. You have some early stage stuff you're thinking of spinning out or not sure what you'll do with now. But, you got Manh Choh, you got Lucky Shot, and you got Johnson Tract. And all 3 of those have their own kind of unique characteristics that match DSO, of course. But maybe let's start with Manh Choh. Obviously, that's the one that's producing cash. It's it's being fed into Fort Knox, and it's quite a nice thing to see actual money come into a mining company. Just give me a brief overview, and maybe we will discuss again. I mean, if you've been following this story the last 6 months, there's been a couple of news releases that kind of put some cloudy clouds, some dark clouds or whatever on the horizon a bit. But I think that let's kind of put a pin in those, or we'll treat them as their own conversation afterwards, Rick. So let's just kind of talk about Manh Choh as is, and just run us through it, right? I mean, yeah, it's a shorter mine life, high grade, and it's producing. But what else can you maybe say to us to help us understand Manh Choh?
Yeah. So if you flip up to the next slide, it just shows it's a series of photos, but it shows here's what's happening at Manh Choh. It's a run of mine, ore averages between 7 and 8 grams per ton. It's loaded on those highway trucks. It's stockpiled at Manh Choh and then loaded on the highway trucks that deliver ore to a stockpile at Fort Knox. And then, as I mentioned earlier, batch processed once a quarter for roughly a month. You're running through, again, rough numbers, 250,000 to 250,000 tons of ore in a batch. And you pour doré on site. So it's a crush grind crush grind CIP mill, and then you end up with basically a gold silver doré bar. We don't really have a lot of silver in the ore, so it's most of the value. We report gold equivalent, but it is mostly gold. We produced 42,000 ounces, and we received roughly a $40 million distribution for the gold poured last year. Roughly $1,000 margin. Just kind of rough numbers. And if you go back to the other slide, you can see I guess there too. So there's the metrics for our production for 2024, and we made money, and we paid down the debt. We delivered into the hedge book, and the hedge book is definitely what's hurting this company. There's no question about it. And you pointed out that we only had a little over 12 million shares outstanding. I would have liked to have raised more equity, but as you know, the equity markets just have not been there. And so, unfortunately, that meant we had to take on debt, which meant you had to hedge, because bankers aren't going to lend you money without a hedge. And hedges are intended to protect the downside, which they do. But when you have a ever-increasing gold price, and when we put the hedges in place, I'm thinking it was around $1,800, the gold price, and the hedges were at a little over $2,025. Who knew the price of gold was going to go to $2,900 in such a short period of time? Mm-hmm. Well, that hedge book is definitely what's hurting us. Bottom line is we're producing, and we have a plan to produce about 60,000 ounces of gold this year. Our costs have increased. We're up around $1,625 for the year. That's a good slide that shows the projected cash flows for 2025 and then for life of mine. So you can see the AISC there for the life of mine is $1,400. For net this year, current year, it's higher. It's around $1,600. But you can see, we're still going to generate a lot of cash flow. We're 70% hedged now with the adjusted hedge book. So basically, the hedge book to deliver into, we just spread it out over a longer period of time, same number of ounces, but just spread out over an additional 2 quarters into 2027. So we're 70% hedged for this year and next, and then very little for 2027, 28, 29. So just like I said, the first 2 quarters, I think it's around 15,000 ounces in 27. So we're going to generate a lot of cash flow, a lot of free cash flow after the hedges are delivered into and the debt's paid off. We're generating over $150 million of free cash flow at a $2,500 gold price. This is all based on $2,500. Or the base case is 25. We showed the upside cases there.
Yeah, well, maybe I'm just scrolling down. I have questions around debt and what you have. You have a $20 million credit facility. You've got $38 million outstanding in debt, plus I think about 89,000 hedged ounces. So I do have a couple of follow-up questions on Manh Choh there, but I guess to help people understand, there's a very powerful sort of economic engine here at Manh Choh. You just, like you say, you got to sort through the bankers first here before it can really start to get realized for you guys. Right. Maybe just help me understand. I mean, how much did you pay down in 2024? Maybe we'll start there, just in terms of helping people understand numbers.
Oh boy, I wish I had my CFO on the call here. Let's see. We had we started out with 60 million, so we're down to 38. So what is that? 22 million. 22 million.
Yeah. Okay. Yeah. And then, so a similar question is, and even just ballpark, I don't need it down to the dollar, down to the penny, but is that a similar amount of cash being earmarked for debt servicing this year?
We'll get the debt paid. A big part of it's about $20 million down this year. Yeah.
Yeah. Okay. Yep. And I guess this is a thing that you mentioned it, you referenced it, that these are not long-term debt facilities. These are not long-term agreements. I mean, in the original agreement, you would have been debt-free end of calendar year 2027. Now it's been stretched into just another, like you say, 2 quarters to midway point of 2027, if I'm not mistaken. So fairly aggressive, fairly quickly. This is not something that's going to linger for a decade as you try to pay these things back. So you restructured your debt. It allows you, I guess maybe I'll let you answer this question rather than just kind of going off it on my own. But I mean, yeah, I think the core thing here is that it allows you more exposure to spot price. But can you just discuss the primary advantages? Is it just a bit more flexibility in terms of debt obligations and cash flow exposure, or is exposure to spot price? Is that, I mean, is there? Can you maybe just discuss that a bit more for us?
Yeah, I mean, that's why the sort of the simple way to think about it is that we're 70% hedged at the 2025, and then 30% exposed to the upside. And that's it's not exactly even across all of the every quarter that we're delivering gold, but rough numbers it is. So yeah, that if you think about us in terms of the upside is on the 30% of a batch of gold processing.
And then typical.
So yeah, today today I haven't actually looked at the gold price this morning, but last time I looked it was 28.50 or so. So we're capturing that upside for sure.
Yeah, absolutely. I think, you gotta, well, what a crazy world for a 2025 or 2050 or $2025 hedging to be somehow disappointing right now that we're up to 2,900. Somehow people can managing to whinge about that, eh? What is though typical G&A burn rate, non-exploration, just G&A? What's your burn rate annual there too, just to help people sort of fit these pieces into what's happening here?
Yeah, I'd say it's less than 5 million. That's to run the company. U.S. companies are more expensive to run. Everything, lawyers are more, accountants are more, fees are more than the typical, TSXV company or something like that. So, yeah, and then we've got a pretty. It's not a big staff, but we've got good people who are advancing those other projects. So, we're going to stay steady in that and just keep advancing things slowly. And most of what we're doing right now is actually permitting related. So that's we can talk about Johnson Tract. That's really the next big thing we have to do there. So we can talk about that when we talk about the individual projects.
Yeah, well, this is actually maybe a decent spot to head back to Manh Choh. I think that this is it's not you kind of have a foot in multiple worlds here, right? There is an exploration aspect to this. I mean, I know that Kinross has already kind of pegged that they figure Manh Choh, I think life of mine takes it to 28. They figure it's good to at least 2030 as is. More room for I mean, there is an important aspect of exploration here, but it is also a bean counter and numbers game too, right? Let me just finish off Manh Choh just so I can kind of tie that loose end off in my notes here. But so I mean, your 70-30 Kinross JV. Maybe this is so obviously they're driving the bus in terms of future exploration.
Yeah, so you agree on a budget. The way that the joint venture works is you agree on a budget for the year, and included in that budget is exploration. And I don't remember the number exactly, but it's in the $4 or $5 million range on a 100% basis. So we will be contributing 1.4 million dollars towards exploration. And the focus certainly is on extending mine life. That's the number one priority. I think early on, last couple of years, is there any other low hanging fruit out there that you can go that's similar to Manh Choh that you was right at the surface and you can go find? I think that was the last couple of years' focus, and I think this year is probably going to be. They did drill between the pits, which is one of my favorite targets because the two ore bodies dip towards each other. And when all we need to find is if we find another year's worth of ore, I mean that's another $80 million of free cash flow for it. So it's very, very meaningful. So that's where the effort and the emphasis should be for exploration for sure going forward.
You tell me if you know the numbers or if I'm way off, but is it 8 or 10% of their annual ounces are coming from Manh Choh currently for Kinross?
Yeah, no, it's a small mine, but because of the grade, it'll produce 200,000 ounces of gold this year. That is not a small mine.
Yeah, not too shabby, eh?
I mean, its footprint is small, but because of the grade, and it's significantly enhanced Fort Knox, the reporting of Fort Knox, or in terms of. But by every metric, in terms of total ounces, in terms of all-in sustaining costs, Fort Knox is a very low-grade deposit. So there's, this is a nice shot in the arm of grade.
Yeah, well, and certainly is a motivating factor for them to make sure they can keep it online too. Then, right? Yeah,
Yeah,
like you say,
exactly.
that alignment of philosophy. Well, why don't we just let's switch to Johnson Tract then, right? We've got Johnson Tract and Lucky Shot. I want to talk about both. I mean, Johnson Tract obviously is a larger and I mean a more important project, if I can be so bold. Let me just get down here to it. Excuse me. There we go. So Johnson Tract, and so I mean, I'll give you the opportunity to walk us through very briefly. But I mean, you can see on the sidebar here. I mean, again, very large. Depending what spot price you use. I think the base case gold is 55% of dollars in the ground in situ. I think at current prices it's more like 75%, give or take. But yeah, 1.1 million ounces gold equivalent, very high gold equivalent ounces. So again, that nice high grade thing, but bigger than Lucky Shot or Manh Choh. Again, you got it from high gold there. Boy, is that a year ago or so? Can you just explain? Again, just maybe I just did this for you. Excuse me, but can you just run through Johnson Tract and again what attracted you to it, why it fits DSO so well for you?
Yeah, so I know this project really well. So as you know, I've worked in Alaska a long time. We actually found this deposit when I worked for Anaconda. I wasn't involved in the team that was working on it, but I worked for Anaconda in Alaska. This was back in the 80s, early 80s. So it's a great project, but you can see its location. It is in the Lake Clark National Park and Preserve. Now, it's on land that's owned by Siri Corporation. Siri is Cook Inlet Regional Inc. is one of the large regional Alaska Native corporations, and they selected this land before the park was there, and so they have very, very special rights as a result of the Alaska Native Claims Settlement Act, which deeded them the land. The park was actually imposed on their lands, and so they have very special rights. So that knowing that's when I go down my list of how easy is this going to be to permit, that's a big box that got ticked, because Siri is they're not a poor Native corporation. They are a very wealthy Native corporation. They're very business oriented. So that makes permitting a little easier because you don't have to have the whole discussion with the public about what's best use of that land. So that got permitted relatively quickly. It's basically reducing your impacts on wetlands. That's a U.S. Army Corps of Engineers permit. So permitting the underground is the next step because we have to get underground to really do a feasibility study on this ore body. This is a location of the ore body. You can see it's really in steep terrain. It outcrops really well, but the mountain to the on the right side of the photo is a big mountain. So there's no way you're going to move that thing out of the way. So approach it underground. You can see that in the lower image there, the road access that's just now permitted. Build basically a 1.5 kilometer tunnel to get underground and just drill the heck out of this thing. If you go to the next slide. It shows, on the right is the plan map that shows the proposed tunnel getting over to the ore body, and the ore body is pretty well drilled from an indicated standpoint. But for an underground mine, as you know, you need to develop measured reserves to put a mine plan around. So that's basically what the underground is proposed for. It's an exploration adit or a tunnel, but it'll double as the main draw point for the mine itself. The underground tunnel gets right into the guts of the ore body. The purpley blocks there, and this is the block model from the PEA that we'll be putting out here shortly, and it's open, and you can't physically drill it from the surface. It's just the mountain's in the wrong place, and the holes won't go where you want them to go. So, obviously from an exploration side, it's not hard to look at that and say, okay, well, you can significantly increase tonnages if you just go down dip and along strike. And obviously we'll be opening up all that ground for drilling when we put the tunnel in. So we're permitting the tunnel now. It's a state permit. We've been working with DNR, Department of Natural Resources, for about close to about 6 months now, I guess, formally. And we expect that to take about a year to get permitted, and then we can start getting the underground put in and complete the feasibility study.
Yeah, but I guess maybe the question I have, maybe fundamentally is, how did you approach this, right? So I mean, you have this model DSO where you've got, I mean, Manh Choh officially, I think it was 4.5 years of mine life. Looks like it'll stretch to 6.5 or 7 pretty comfortably. You've got Lucky Shot, same thing, very high grade but smaller. And so for me, maybe the question I had, so I mean, PA coming in March, and so these are working with numbers that aren't official yet. But I mean, from your slide deck, if I can try to just get this up as reference, I mean, just in so target is 150,000 gold equivalent ounces. I mean, I know that always when it comes down to just trade-offs, and there's infinite variables that you measure in trade-off studies, and you just decide what the best bang for the buck. But was there any motivation or conversation around maybe as a degree of stability for your DSO model to help you sort of hop and that risk of execution, right, where a 1 or 2 year delay could potentially scupper things for you in a serious fashion or take some serious blue sky off? Was there ever discussion about maybe stretching it out and right now I'm going to call this a mine life of roughly 6 years for Johnson Tract as is. You can tell me again if I'm way off, but was there ever conversation about having it and doubling it to 12 years so that it provides more of a stable base for your company? Is that a conversation that was had, or why or why not?
Yeah, no, it is definitely part of the conversation. And that actually brings up, okay, where are you going to process this stuff? And so those are the conversations that we're having now. And so they'll dovetail into the feasibility study. I think, the purpose in my view, the purpose of a PEA is to tell the market that this is a viable project, and it's worth spending, the next $50 million on. It's not a document that anybody should sort of hang their hat on, and this is how it's going to get developed. It's really, to me, it's a hall pass to do the rest of the work.
Sure.
To get there. But I think your point's a good one, and then it really does get to, okay, where are we going to send this? And we're having those conversations now. There are several places that this could be processed at. So I guess stay tuned for what that looks like, because obviously the receiving end is what's going to help, capacity wise, going to help answer that question. But questions definitely. Is part of the conversation.
Yeah, no, fair enough. We'll have to wait for those darn pesky CAs to get lifted so we can chat afterwards, right? But yeah, no, I mean, again, I maybe I feel like I'm not doing it justice here. I mean, again, very high grade project. I think it was a great deal for high gold. I think this is one of those things where a degree of patience, if you can and continue to successfully execute on this model, I think that there are very good days ahead for Contango shareholders, of which I have to probably be clear I am one. Just for the sake of time, Rick, I think I'll probably bypass any further conversation on Lucky Shot. But let's just talk about these issues that are kind of the recent news developments around bridge restrictions and around moisture content, because fundamentally I want to ask in the end, are these restrictions, or are these are these restrictions causing a change in your strategy in terms of exploration, in terms of drilling, in terms of how much money you can spend and where you spend it? So maybe let's just talk about it really briefly, right? You had bridge issues. There was a weight restriction reduction that occurred, reduced the average truckload by 2.5 tons. The cruel irony after the market kind of wet its pants or whatever, wet the bed about it, is that by end of year last year, just a month or two ago, the state and federal DOT actually agreed to funding, right? So I'm going to editorialize here for a second, just for the sake of expediency. Again, I apologize. Is that that I think that what you're seeing right now in the market, and I should probably let Rick do this. I'm carrying water here for Contango, but absolute worst case scenario is baked in. You guys are at $9. I think that's absolutely ridiculous. You're approaching a 5-year low. I don't understand how this happens. From my perspective, you see there is a ridiculous amount of failure being baked into the share price of Contango, and that pendulum swing of momentum and morale, investor sentiment, always and inevitably swings too far. And so I really do think this is one of those moments where if Contango matches your own risk profile, you should be taking a very close look at them, because I think that unquestionably that momentum of that pendulum has swung too far, where I think they're assuming that you're just going to kind of close up shop and cease to exist in 6 months right now at your current valuations, right? Not that you have...
it makes no sense. I bought stock. My chairman bought stock. We're in blackout right now, so I can't buy stock. But It's it's certainly disheartening, but the bridge weight restrictions they were still in place. Now that they have alignment with the federal government, and it wasn't that they weren't aligned before. It's just that they didn't do Alaska DOT didn't get everything done that they needed to do to fill all the boxes that the federal DOT wanted filled, and so that got done at the end of the year, as you said. That doesn't take off the bridge weight restrictions, but what it does do is it puts a timeline on when the bridges will get repaired, and then that then goes into the new calculus that they really look at the bridge weight restrictions and do they actually need to have them in place anymore. That probably won't happen until the summer. Same with moisture content. I mean, these are all operational things that you identify as an issue, and obviously you have to operate to identify them as an issue. And once you do, you put a plan in place to say, okay, how can I reduce moisture content? Well, I can put some drainage over by the pit so there's not so much water over there accumulating. Same with the stockpile areas. Put some more fill in, and so the water doesn't accumulate and turn into ice and snow, and which is more difficult to work with and all that. Put a wash plant in so you can wash the trucks off in the summertime and get the 1.5 or 2 of mud off in the summertime, and same with the ice and snow in the wintertime. Just physically knock it off. So all those things are happening. There'll be incremental improvements we expect to achieve over the course of the year. Hopefully the bridge rate restriction comes off. If not this year, maybe next year. And so, those are all things that are happening now, and they'll get reflected when we pour gold and put our costs together. So we have our first our annual reporting for 2024 will be coming out in March, I think later in March. So, you'll see cash costs and production, typical. You will see them actually reported and audited. Obviously, we're giving guidance in the slides here, but I mean, we're not a going concern. We don't have any hope of running out of business here. That's just kind of ridiculous. And it was disappointing to see our share price get cut in half, basically. I think we still have great assets, and we have we have a great plan, and it's a unique plan. It's different than everybody else's. And we've got high quality assets that will make money. Lucky Shot here, the difference between Lucky Shot and Johnson Tract is Lucky Shot smaller and would be looking at sort of 40,000 ounce of level of initial production, but it's fully permitted. So I can throw rocks in the box and haul them down to a mill. It's only 20 miles down to the railroad. That gives me a lot of flexibility. I can go north, I can go south, I can throw it on a barge, and then not quite the world's my oyster, but pretty much.
Well, no, I think that again, there are so many paths towards success and improvement, and I mean, bringing on new projects, improving current projects. That I mean, again, I try to be objective, but I also try to work with companies I actually believe in, so there's this kind of tension for me where I don't want to sit here and cheerlead, but I fundamentally think that there's a heck of a lot of success yet to come for Contango if you can continue to execute. We're a little bit of a time deadline here, so I'm trying to be brief here. Apologies, Rick, you got 3 minutes, but I can't help but ask, I mean, will this, and I'll let you segue this into maybe a preview of 2025, but the challenging question, and I'll just get you back on, we can maybe chew the fat a bit better in more detail, but how have these restrictions changed has it changed exploration plans? I mean, for 2025, is still the exact same plan as it was previously?
Yep. Yeah, I don't see any change in our approach. We think, again, Lucky Shot's a relatively small mine, so we're going to be moving. It's a much smaller amount of tons we'd be moving to the rail and then loading it up on the railroad. So, and then Johnson Tract is it's out in the middle of nowhere. It just happens to be only 20 miles to the coast. So, I think nothing we're seeing in terms of the federal government. In fact, I only see better things happening, at least for the next 4 years. We have an administration that wants to develop mining. Former administration talked a lot about critical metals, but they had more executive orders, specifically in Alaska, that cut down resource development than any other administration ever, period. So we've seen that reverse. I hope that they get to true permitting reform at the federal level. It's needed. And not just for mining, it's needed for for bridge construction. It's needed for building windmills and solar facilities. The permitting process is broken and needs to be fixed. So,
No, well said. And so maybe just what the final thought, and it's a classic question that I think will help us understand what's coming, but just 2025, you have a PEA coming out for Johnson Tract. Can you just run through, I mean, yeah, in 60 seconds or less, can you run through the meterage or drill campaigns planned for exploration for your project?
yeah, so that's something we're on hold with exploration plans right now. We're working on putting a plan in place, but we want to, first order of business is to pay off the debt and deliver into the hedges. And so we are working on plans to get to do more exploration work. But right now the focus is going to be on permitting Johnson Tract and obviously looking for getting a deal in place that would be a mill to process the ore from both Lucky Shot and Johnson Tract.
No, good. Well, we'll call this the end of part A, and I'll get you back on again here soon, Rick. Thanks for your time. Rick Van Nieuwenhuizen, CEO of Contango Ore, CTGO.NYSE. Thanks for your time, and we'll speak again soon, Rick.
Matthew, good to see you. Take care.
Cheers.